Hi everyone, thanks so much for joining. Can you believe another month? Monthly jobs report is here already. We've got the May report. It's super important. It is the first major piece of data that Kevin Walsh, as the new Fed chair, will see. Remember, he's not that keen on forward guidance, so he will be led going forward by the inflation report, by the jobs report. So it just adds more significance to this economic data, which also means there'll be more volatility. Now, there is a lot of background as we lead up to this NFP meeting. I'll just run through quickly what to expect. 85,000 increase in jobs. That would be kind of 2 solid-ish months of job growth. Very low unemployment rate, 4.3%. That's expected to remain the same, and then a 0.3% increase in monthly average wages. So pretty good growth. As we move up, as we've moved through May, we've had some lead indicators. They painted a fairly mixed picture at the moment, with the ADP being stronger than expected, more job openings as well, which suggests a tighter labour market. But then we also had that Challenger jobs report, which suggested that layoffs were at their highest level for 3 months, and that we also saw layoffs in we also said the reason for layoffs was for the 3rd month running AI related. So we do need to watch out what's going on there with some layoffs in that tech sector. But we don't believe that this month will show that there's kind of been some jobs apocalypse going on. We just don't believe that that's the case. And we also think that we will probably continue to see the bulk of job growth will be in hospitality and in education. So 2 sectors that are very AI proof, but we will be looking to see if there's any weakness in professional services, business, financial jobs, because that's obviously where you really mostly see the AI linked job volatility. But let's dive straight into the charts, because as I mentioned, it's not just about jobs. Today is when we get economics, we get fundamental data, but we get concerns about the AI trade, and of course we get those rate hike expectations all kind of converge together. The chart that you're looking at right now is the just global equity indices, and I just want to show something. We saw a big sell-off in the South Korean index today. That was down 5.5%. The Japanese index as well, down 1.3%. Yesterday, there wasn't too much movement on the overall NASDAQ. The S&P 500, again, that just inched higher. So did the Dow Jones, that reached a record high, but beneath the surface, there was some real concerns. And that was down to tech, really massively underperforming. But if you look at the stock sectors that did the worst yesterday, they're the ones that have done the best over the last 3 months. So South Korea's index is still up 48% over the last 3 months, 21% for Japan's Nikkei, and 12% gain and 20% gain for the S&P 500 and the NASDAQ in total. So that's kind of something to watch there. Now, we're also looking at markets, obviously. If we just quickly, just wait for this to load. Yeah, so as you can see, the NASDAQ 100, so that's just the biggest tech companies, that had a bit of a deeper fall, but largely if we just move down here, that was driven by Broadcom. Broadcom fell quite sharply yesterday, down 12%, but that is a big chip maker. But the big news from that is that it actually lost 280 billions worth of market cap, which is one of the biggest historical drops in market cap ever. So that was certainly something to watch. But as you can see here with US stocks, the Magnificent Seven, they drew a lot of interest. So we're seeing a bit of rotation out of some of those most highly valued stocks, the likes of the Broadcoms, the likes of Micron, the likes of SanDisk, those stocks that have really had a really strong run up, very strong AI theme there. And they've really had a strong pullback. But we've seen people seen investors go into other sectors and also go into the likes of Nvidia and some of those big Magnificent Seven stocks. Now, I just quickly want to show you foreign exchange. Oh, here we go. So the dollar is weakening actually into this report, only slightly. So we've got stronger cable, stronger euro. Just bear with me now, guys. I'm just going to see. We're going to just wait for the data, and I'll tell you it as we come in. So again, it's 85,000 that we're looking for. We'll be just going back to that chart really super duper quick. Let's take a look at what euro dollar is doing. So yeah, so euro dollar, so it's really hovering. There's not been too much movement in euro dollar yet. But obviously that could all change as we get this data. So let's take a look. Let's see what it is. Still waiting for it to come through, guys. It won't be long now. But again, no change unemployment rate expected. That's expected to remain stable at 4.3%. And as you can see, euro dollar just backing away from those highs on the day, but really a 0.16% move. Oh, it has fallen. There we go. We've had the data out. What have we got? A much stronger reading than expected, 172,000. The unemployment rate stays at 4.3%. Let's take a look at average hourly earnings. They're up 0.3%. Average hourly earnings on an annual basis have remained steady at 3.4%. So a much stronger non-farm payrolls report than expected. Wow, that is a real big one. That is one of the biggest readings that we have seen. Let me just take a look. When did we last see this one? See anything this high? My goodness. It doesn't really seem like we have... payrolls have remained very elevated, actually. So again, around about that same level, we were looking for a decline from April, but we just haven't seen it. We've seen a step up, actually, in payrolls growth. So that's really worth noting. I'm going to stop sharing there for one moment, and I'm going to share my other screen so that we can really take a look at what's going on. Bear with me one moment. Yes, so this is my CoinFin screen, guys, just to show you really that technology has come under a bit of pressure as the market has been digesting what's been going on with AI, that maybe we've reached kind of a bit of a top, and the Broadcom earnings miss was seen as a bit of an excuse to sell off because it was very richly valued, but there's also expectations of a rate hike. Now, if we go into the 10-year bond yields, this is where we're going to see real movement, and we would also, as we've just seen quite a sharp decline in the sharp decline in the euro, so strength in the dollar. We're not seeing it come through, just a little bit in bond yields. Okay, let's go back and we will have a quick look at what is going on with markets right now. I'm going to share back to my other screen so that we can take a look at that. Sorry for all the umming and ahhing. Let's see where we are. So yes, we've really fallen. We're falling back towards that 116 level there for euro dollar. Let's take a look at where we are with stocks as well. Remember, this really increases the chance now of a rate hike at some point this year from the Federal Reserve. That's going to be bad news for stocks in my view. Yes, we've seen a bit of a pullback now in these European markets. Nothing too much, but look, the DAX is now just up just a touch. The FTSE is a little bit more resilient. Remember, it has a bit more of those non-tech sectors which the market is liking. If we just look at the pre-market, let's just take a look. So Broadcom, which was that big decliner from yesterday, that is still declining, I believe. Oh, sorry, bear with me one moment. Broadcom is still declining, which is not surprising, really. Broadcom is declining, and it is... Yes, it's down over 2% now. So that payrolls report has triggered another decline. And just bear with me, I'm just going into some of the details. So absolutely blew past expectations, this payrolls report. It really, really did. It's a bit of a stunning report. But as you can see, further declines for those AI darlings. But let's take a look at NVIDIA, because NVIDIA really does represent that really kind of cash-rich, almost defensive-like tech stock. That rallied yesterday, but it is also lower again today. So we are expecting to see a little bit of a rout as we move into the US session, into the end of this week. The market is definitely letting off steam, but there is also expectations about what's going to happen next from the Federal Reserve. As I mentioned, Kevin Warsh, he's not a fan of guidance, forward guidance. In fact, he said that he would rather kind of drop forward guidance altogether. He gives quite sound reasoning for this, essentially, that it's often inaccurate and it just creates extra market volatility. But what that means is that there's going to be less hand-holding from the Federal Reserve, and there's going to be more focus on the labour market report, the inflation report every month. So this is going to move markets, and we're seeing that here with NVIDIA in the pre-market, and we expect that to continue later today as well. I will also just say as well, we've seen expectations for a Fed rate hike, so expectations of a Fed rate hike were about 40% yesterday by the end of the year. So we've priced out completely rate cuts from the Federal Reserve, and I think that this report will really put the prospect of rate cuts to bed. We know that the US is doing really, really well. I'm just waiting to see where we are now. So no expectation of a rate hike next week, but by December, Yeah, we're still looking at about 50% chance. There's still a real even chance of what will happen at the next Fed meeting. Let's take a look at dollar yen. Dollar yen has been obviously very, very close to that 160. It's gone over 160. So as you all know, for those of you that love dollar yen, I know a lot of you do, 160 is a bit of a line in the sand where the Japanese authorities have been going in the past and weakening the dollar, strengthening the yen because they're worried about the inflationary impact of a really weak yen. If we just take a look at that, as you can see, dollar yen just popped higher. It's just gone back to that 160 level. Now the market's testing that 160 level. Will Japanese authorities come in and dampen the yen? If they do, then we could see some big swings like we've seen in the past over the last kind of 6 months, from big swings lower in dollar yen, and that's all because of official intervention. It doesn't look like they've done too much over the last kind of 3 weeks, but they definitely could come in and just weaken the yen there. But it does suggest that official intervention isn't enough to combat the strengthening dollar, which is really making a comeback as we see this kind of continuation of strong data. This report does suggest American exceptionalism, so we could continue to see a bit of a rotation out of tech and into other names. If we just take a look, if I just kind of guide you through, well, what did well yesterday? On a sector basis, we saw healthcare, financials, and real estate do really well, and then we saw technology, consumer staples, and well, mostly the sell-off was localized to technology. Actually, consumer staples was only just down a notch, but the other sectors, so industrials, utilities, consumer discretionary, healthcare, financials, obviously they led the way higher. So there was a rotation out of tech and into these other underloved but much cheaper and better value sectors. So that's certainly something to watch. And actually, if we just take a look, as you can see, Nvidia there is falling, but let's take a look at what JP Morgan is doing. And the reason why is JP Morgan is obviously the world's biggest bank, the US biggest bank. That is pretty much flat. It had been up 3.3% yesterday. So even if we do see a bit of a rout in US stock markets today, there'll be some sectors that will be more resilient to it. And that includes JP Morgan and the financial sector more broadly. But if we just take a look again, just go back to some kind of pricing data about what's going on with European stocks. So it's just taking a little while to load on my end. As you can see here, yeah, I mean, look, the FTSE is definitely showing, again, some more of that resilience because it's not got any tech names. Now, you know, we've got a lot going on in the next couple of weeks in terms from a stock market perspective. We've obviously got that SpaceX IPO next week. So, you know, a falling market into that doesn't necessarily bode ill. But I think, you know, this Broadcom miss yesterday, remember the chip maker, it still had some pretty good numbers in fairness to it, but it just missed revenue expectations, that future AI revenue expectations that although high, it just wasn't high enough because the price, Broadcom had rallied about 40% year to date ahead of yesterday's decline. So it's down, now it's about up just over 20%. But it's really an opportunity for investors to cash in, maybe to take some profits. But I don't think it necessarily changes the long-term narrative. Because, you know, Broadcom is, you know, there's still a lot of demand for AI stocks. That's why we have the likes of SpaceX listing, but it is a little bit of a red flag, just that, you know, the input costs, the cost of running these AI businesses are going up as well with the rising cost of energy. So that is something to watch out for. And there's still a lot of AI bubble chatter that's just feeding into a bit of nervousness in the market. And obviously, US stocks won't always be propped up by these kind of big AI names necessarily in the future, but we still think that, you know, everyone's been talking about the narrow breadth of the market and how we're in a bubble and it's going to pop. It hasn't done so yet, but it certainly has had periods of pulling back. And I think that's what we're experiencing now. What's been interesting in the past, those pullbacks have definitely, oh, there we go, there's a FTSE 100 chart, have definitely been led by the likes of Nvidia, whereas this time Nvidia is acting like kind of the stable older brother of them all that is, you know, more responsible than some of these other AI companies. But obviously there's a lot of questions to be asked, but I think the big takeaway from today's data is what this means for Fed policy. Let's just take a quick look again at Forex because, you know, Forex is obviously super important right now. Dollar yen, obviously I expect to see us we've just backed away. That's really interesting. Just backed away from that 160 level, and it's continuing to decline. That could be official Japanese intervention. We shall have to see. But overall, much stronger than expected payrolls reading. This is something to watch out for. It definitely is what a whopper of a payrolls report. 2 strong months of payrolls to welcome Kevin Walsh to the Federal Reserve. Well, he has a lot to discuss, but it could certainly put to bed expectations that Federal Reserve will be cutting rates anytime soon. And if anything, we expect it to boost chances of a rate hike later this year. But we do need to see a bit more detail. Do follow us for more. We're going to check out our YouTube channel, check out our social accounts on Instagram, on Twitter, and of course, on TikTok is what I meant to say. And also follow all our analysis on the website where you will get more. But thank you guys so much for joining. Another whopper of a jobs report from the US.